Well, good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to the live stream. We sincerely hope that all of you remain safe and healthy at this time. Today, we have some truly special guests and friends of mine from our National Tax Office, Melissa Labonte and Miriam Wisnicki. They are here to give us an update on the currently changing legislative landscape, share some thoughts they have, and answer your questions live while we meet today. But before we get started, as always, we're going to quickly review our housekeeping items. As you know, we have activated live Q&A so we can interact with you during the show. If you're registered, you may add your questions and also like the questions of others to move them up in priority and hopefully have them answered during our time together. I'm told we have a ton of people with us already, so hopefully we can get to all the good questions. I'd also like to urge you to subscribe to the CLA YouTube channel and hit that like button on the live stream so that they're easy to find and you're notified of them in the future. I also want to take just a quick second to make you aware of our upcoming sessions. We have a state and local government webinar on November 9th called Managing Your ARPA Funds. This webinar is targeted to state and local governments and will cover all things related to ARPA, the fundamentals of the program, retirements for plan administration, and more. On November 17th, our financial health and webinar series for individuals continues with year-end planning. And then we have an IT webinar series as well. On November 23rd, it'll be cybersecurity and incident management, and that's going to be for considerations on financial institutions. So lots to watch out for. I would urge you to just visit our events page on claconnect.com to register and find other relevant events for yourself and your organizations. Finally, please continue to engage with your advisors here at CLA. We're always sharing articles and white papers, and we're looking forward to interacting with you when you use that Contact Us button on our webpage. So without further ado, I'd like to bring Melissa on camera with me right now and get things started. So Melissa, we have so much happening on Capitol Hill right now, and I think that's where we're getting so much excitement. So could you give me a summary of where things stand as of today?
Absolutely, Jen, and you are exactly right. Things are changing. I would say on an hourly basis. When we first got on this webcast, I thought something had dropped in the last half an hour. Luckily, that's not the case because would not have been prepared. But there are basically two major bills right now going on in DC. First, we have the physical infrastructure bill. That's that $1.2 trillion package, about half of which is new spending. Remember, it passed the Senate back in August. It was bipartisan and went through regular order, so it got 60 votes through the Senate. It's now being held up in the House, not because of any decision, but it's being used as leverage. The House progressives decided they're not going to vote on it until the reconciliation bill is also being passed. This is because they believe they won't have the votes to get everything they need in that reconciliation bill. So the second one, of course, is the reconciliation bill. You may remember over the summer, we had both the House and the Senate pass that framework, right, that said that they would include everything related to the president's social priorities, and it was approved for spending up to $3.5 trillion. That was like the top line. Well, since then, we've had a lot of back and forth. That top line has since been cut to about half of that cost, and there continues to be negotiations daily and nightly. And it's hard to keep up, honestly, as to what's in and out of the package, as well as how they plan to pay for the package. That's also had a lot of changes. I think it was about 2 weeks ago when Kirsten Sinema came out and said she opposes an increase on the individual income tax rate, on the capital gains tax rate, and some other changes as well. So the administration came out, they had a revised plan, and then just this week, the House released an updated legislative text as well. So we've had a lot of changes over the month, but we're not at the finish line quite yet. There could be, and I would say there likely will be, more changes before something gets passed. As for timing, it's uncertain. Speaker Pelosi would love to push through the reconciliation bill and the infrastructure bill as fast as she possibly could. But I have to tell you, the moderates, they would prefer that everything gets slowed down and make sure that they get everything right. And keep in mind, even if they were to get something passed through the House today, which most people think is a little optimistic, it would still take time to get through the Senate, right? So this entire time we've been saying this could easily be a December exercise, and I think we are still on target probably for something to get passed in the December timeframe.
Yeah, thanks so much, Melissa. It's funny, I just had that conversation with a client yesterday saying the same thing. They were very anxious about what might get passed, and and I said, listen, there's still some time that has to go on here. So this is a super helpful, just where things stand right now. Now, one thing I heard you say that kind of speaks to another issue that we're having is there's a lot of confusion around tax increases. And I thought I heard you say that tax rates are not going to go up for individuals. Can you speak to just the tax increases a little bit?
Absolutely. As I mentioned, legislation continues to evolve, but we had Kirsten Sinema about 2 weeks ago say no, a hard no to tax increases, direct tax increases. So the latest proposals do not have any changes to the individual income tax rate or the capital gains rate. Instead, they have a new surcharge is being proposed. And a surcharge is more aggressive, it's more extreme than a normal tax increase because it applies to gross income. You can't deduct things like state and local taxes, mortgage interest, charitable contributions. It wouldn't apply to everybody, though. The latest version that I've seen, there would be a 5% surcharge on gross income over $10 million and an additional 3%, so a total of 8% on gross income over $25 million. Now, I'm using, very high level terms. It's actually a little bit more technical than that. And by the way, if you have trust, those thresholds are much, much lower. That 5% surcharge kicks in about $200,000. And then that 3%, the additional 3% would kick in at $500,000 for trust. And there are some other changes in there as well, Jen, like some special rules with taxpayers that have very large IRAs. And then, of course, we've been talking about this the entire time. The SALT cap, the state and local tax deduction, is also on the table. Right now, under the current rules, that deduction is limited to $10,000, and it's scheduled to stay that way until the end of 2025. The latest proposal, though, again, still subject to change, would increase that from $10,000 to $72,500, but not just through 2025. The proposal actually would have that limit for the next 10 years. So a lot of changes going on, but not what we had expected, right? No changes to the individual income tax rate, no changes to the capital gains rate. I know it sounds like I'm repeating myself, but it's such a shift from where we were a month ago that we're still getting questions every day because there's a lot of confusion out there.
Well, and you're right about that. That's just a complete 180 from where we were just a month ago. So I think it's important to reiterate where things stand now and just clarify. I'm sure there's a lot of questions coming in to that effect. Before we pivot to the business issues, can you talk a little bit about the changes to the estate and gift tax rules with me, please?
Well, good news all around in that area for now. The latest proposal does not have any changes related to estate planning, right? So no changes to the estate tax exemption, and then no changes to the tax rules for various trusts that are very common, very common with regards to estate planning. But two things to keep in mind, two, maybe three. First, the estate tax exemption was scheduled to not to expire, but to drop to about $6 million anyway after 2025. So if you have 20 million or more in net worth, there is no reason to wait. You really should talk to your advisors now because you can save more in taxes by taking steps to get some of those assets out of your estate as opposed to pushing it off a few years from now. Second thing I just want to remind you of, Jen, is bad ideas never go away in DC. If there is a proposal and it raises revenue, it gets put on a shelf. And then the next time somebody needs revenue, they pull it off that shelf and it gets stuck into a bill, sometimes at the last minute. So it's good when you're thinking about estate planning, you need to be aware of these various proposals and how they would affect your estate plan because you never know when they're going to come back into the discussions.
Yeah, I think that's really, really helpful, Melissa. So thank you so much for that. And I know we've got a ton of questions coming in related to these topics, but for right now, what I'd like to do is bring Miriam into the conversation as well. So Miriam, Melissa brought us up to speed on individuals, but what about businesses? Are they likely to see any significant tax changes this year?
Well, very similar to what Melissa laid out on the individual tax side. So that corporate tax rate increase we had been talking all year about that was being proposed, raising from the current 21%. We talked about 28%, 25%, maybe somewhere in the middle. Well, Senator Sinema took the same approach with the corporate tax rate increase and refused to support that. So that is off the table for now. That broad-based corporate tax rate increase is out of the latest package. And what it is replaced with is what's being called the corporate minimum tax, which is really affecting only the largest corporations. The estimates are about it would affect maybe a few hundred of the largest corporations because it's a 15% minimum tax on corporations with $1 billion of book profit. So not going to be a tax with broad-based applicability. Increases for multinational corporations, that's still there, that's still alive and in the package. But things like carried interest legislation, partnership tax reform, those really appear to be off the table for now. That doesn't mean they can't come back. They certainly can, but they aren't included in this latest package. So those are sort of the direct taxes that affect businesses, but I think, there are a lot of indirect taxes that affect businesses because they affect the business owners. And so the indirect taxes that I think we want to focus on and sort of bring your attention to for business owners are the expansion of the 3.8% net investment income tax that remains in the proposal, changes to the 1202 regime, which is a regime that allows for exclusions of gain on the sale of qualified small business stocks, so a serious limitation on those exclusion principles. And then finally, those new surcharges that Melissa talked about, those also can affect business owners.
I think that's helpful as far as what's in, what's out, and what I'd love for you to talk to me a little bit more about, Miriam, is the expansion of the 3.8% tax that's being proposed. Which business owners are going to be affected by those proposed changes?
Well, yeah, I think to really answer that question, we have to get a better understanding of what the current law landscape is on that 3.8%. So under current law, that 3.8% Medicare tax is really embedded in several different tax regimes. So there's a 3.8% tax that's embedded in the payroll tax regime, which is generally applied to wages of W-2 employees. There's a 3.8% tax embedded in the self-employment tax regime, which is applied generally to the self-employment income of self-employed taxpayers. And then there's a 3.8% tax in the net investment income, which is generally applied to investment income and the passive business income of business owners. And so most forms of income really do get captured within one of those regimes. But there are a few different types of income that sort of fall through the cracks of all those various regimes and escape that 3.8% taxation. So as an example, the business income that passes through from an S corporation to an S corporation shareholder, or from an LP partner, certain LP partners or LLC members of partnerships who materially participate in a business, so they have non-passive income, that currently under current law escapes that net investment income tax as well as the other two regimes. And so what this proposal really is intending to do is to make sure that that type of income or any income that's currently escaping that 3.8% Medicare tax would get captured into the net investment income tax for taxpayers that exceed modified adjusted gross income thresholds, $500,000 married filing joint, $400,000 for all other taxpayers.
Awesome. Well, that is super helpful to understand. And you mentioned that business owners may be impacted by the surcharge, but that's only for individuals with over $10 million or $25 million in income, right?
Well, that's true. But the one thing that you need to keep in mind when it comes to that surcharge is, unlike a wealth tax, which the wealth taxes that had been talked about and sort of thrown out in Congress over the last few months, those required that you had to have a certain consistency to those very high income levels. But the surcharge does not. The surcharge is really based on an annual year by year basis. So if you hit that threshold in any single given year, that surcharge will apply to the excess income over the threshold. And so even for business owners who don't typically on a year by year basis see business income levels that high on their individual tax returns, they might have a once in a lifetime exit event, a big sale transaction that does generate really significant amounts of gain and income at the individual level. And so they may all of a sudden fall into surcharge territory where they don't typically. And so it's very important to keep that in mind when planning and structuring these exit events, because the after-tax proceeds of that exit event could be significantly impacted if it does put you into that threat surcharge territory in the year of the event. And you'd certainly want to be reaching out to your tax advisor to start discussing strategy and planning around, if you're going to have an exit event that might put you into surcharge territory after the current tax year.
That makes sense. So are there any steps a business owner should take before now and the end of the year, or between now and the end of the year?
Well, I think now that legislation has taken this really significant shift, and Melissa said the same, on the individual side, I think it's a really good time to reconnect with your tax advisor and sort of refresh those discussions you may have been having and focus on these most recent proposals, because the discussions may look very different. And certainly if you're in the process of preparing a major exit event, I certainly think now is a really good time to reach out to your advisors. There's a lot that we can do in terms of strategy and planning, some of which we can do after the end of the year, but some of which needs to be done before. The only thing I would caution some of our listeners is that we are still very much in a position of tax planning amidst uncertainty. So yes, we've got a new proposal. Yes, it's a stripped down package, but where this all lands, there's still too tight of a margin in both the House and the Senate to really get comfortable that there's not still a significant amount of uncertainty.
Awesome. Miriam, thank you so much. I think
Sure.
The theme of the day and the theme of all of this time that we've been dealing with is connect with your tax advisor, have the discussions, don't hide from, our fear of change, because being productive and having some flexible planning makes a ton of difference. What I'd like to do now is turn to these questions coming in from the audience. There's so many and they're very good. So Melissa, we'll bring you back too. And I think the top question, or at least I'm just going to take them in the order that I'm starting to see them, is, are there any of the gift and estate tax changes proposed by the House still on the table?
That's a great question, Jen. We had the administration's framework that was released about a week ago, and then we had the House Ways and Means updated proposal, just yesterday? And there were no provisions in there related to estate and gift tax. However, there were changes from just what was released a week ago, right? And there are still opportunities for the Senate to make changes. Right now, the consensus is, or at least the momentum, is that they're shifting away from estate and gift tax changes, but you got to be flexible. When we're talking with clients, some of them are setting up these trusts called intentionally defective grantor trust that are used a lot with estate planning. Sometimes we are setting up the trust, but not funding them quite yet. We may even have the transfer documents drafted and sitting in front of the client, and we'll call you and let you know when you need to sign them, right? And maybe that's being ultra conservative, but there is still time potentially to throw something in, especially if it's viewed as closing a loophole, right? Those kinds of things make me a little nervous that they might still be thrown in at the last minute. But generally speaking, no, there are no changes currently in the proposal related to estate and gift taxes.
Okay, thanks so much. I think it's interesting that you talk about closing a loophole when there's a lot of strategies that people employ that they don't even realize are loopholes, right, in the legislation. Then we see things tightening up and realize what kind of an impact that's going to have. So the next question we're seeing here, it's somebody's asking just about the stepped-up basis upon the death of the husband or wife. Can you comment on that?
Yes, there were proposals earlier in the year that when you pass away, maybe I should back up and say, when you pass away today, if you paid $10 for a stock and you pass away, whatever the fair market value is at your death, let's say it's $100 now, your heirs get a basis of $100. And that's important because if they turn around and sell it, there wouldn't be any gain. There was a proposal that instead of having a step-up in basis, that perhaps you would have what they call a carryover basis, which means your heir would get whatever your basis is. In my example, that would be $10. There were also proposals that a gift or a transfer at death would be a triggering event. And it would be the same as having a sale, that even though you didn't sell it, that perhaps you should have to pay capital gain on the appreciation. For now, we really think those types of proposals are off the table, but I would put that in the category that I mentioned earlier, that bad ideas do not go away in DC. They get put up on that shelf, and that's something that whether it's next year or many years from now could easily be taken off the shelf and revisited.
It's funny you say that. I'm going to actually share that comment with my daughter. Her economics class right now is talking about how if politics were not a piece of this, how would they solve our debt crisis? And I think I'm going to say, so bad ideas don't go away in DC. They just get put on the shelf. So anyway, we have a lot more questions on individual, but what I'd like to do just is give you a quick breather. And Miriam, there's a question here saying, what is the status of the 3.8 surtax on active income, otherwise not subject to employment tax? Could you comment on that?
Yeah, so as I mentioned, that's one of the few provisions that have stuck in this package, and probably because it's seen as one of those that is closing a loophole. It's kind of closing that loophole for that small slice and bucket of income that was escaping taxation through those other regimes. So that active business income, what it's going to do is under the new net investment income tax proposed rules, it's going to capture all types of business income that is not otherwise subject to that 3.8% tax under the self-employment rules, under the payroll tax rules, and will essentially ensure that that income gets captured as part of the net investment income tax rules, and thus the 3.8% tax would apply.
Okay, that makes a lot of sense. The next question I'm seeing in here is the capital gain rate expected to increase when earned in 2021? Or if there is an increase, will it be effective in 2022? So I think that's another big topic, right, is effective dates of all this legislation. So I'm not sure if one or both of you would prefer to comment on that, but I'll toss that out to this group because it's a common question that we see with all of this legislation. So Melissa, do you maybe want to start the commentary on that? Miriam, add if there's anything else.
Yeah, absolutely, because we might have two completely different perspectives. For now, capital gain rates are not scheduled to change, right? So that appears to be off the table. If it does come back into play, could they make it retroactive to September 13th of 2021? Absolutely. That was what was included in that initial House proposal, that anything as of September 13th would be subject to the higher rates. I'm going to kick it over to Miriam and see if she's got different thoughts.
Yep, no, I very much agree with that. It still is a possibility, but because Senator Sinema seemed to be really, not supportive of it, and they need her vote to get it through the Senate, it does appear unlikely at this point. I would say the one exception is this sale of 1202 stock, qualified small business stock. That's still on the table, and that's still in the package. So that those provisions around those qualified small business stock rules, which it had been getting very beneficial treatment in the past, are not only proposed to go away, but those would be retroactive to sales of qualified small business stock back to that September 13th date. So that's the only truly retroactive provision. And I don't know, Melissa, if you want to speak to the retroactivity of the SALT provision. That's actually a benefit for taxpayers, but the SALT cap increase is actually going back retroactive a year in the proposal.
It absolutely is, which caught my eye as well. Yep. It goes back to January 1st, but then I had to catch myself and go, you know what? This is definitely not a decided issue.
It's absolutely
right?
not.
There is no agreement. I told myself I am not going to get excited about that yet because that most certainly could change before it gets across the finish line.
Absolutely.
But you're right. As of right now, it would appear as though you could get that deduction for all of 2021. So it's retroactive to January 1st of this year.
Yeah.
Yeah, that SALT issue is like a tap the brakes issue, right? That's going to be one of those things that slows us as we work on that. So back to these questions, because I have to say, I have to celebrate the audience for throwing so many good, thoughtful points on the table here for us. Melissa, there was a question here just asking if you could address the status of the change in charitable giving deductions.
There are no changes right now to charitable contributions. So I think we're good on that. I think there were some small changes, Miriam, but I can't remember them, but some very small, I'm saying small, like $200 or $300 changes related to things like union dues. Yep. And there was another small one that's $200 or $300 employee related expenses that might come back into play, but they were very small numbers. Nothing related to charitable contributions and what came out yesterday.
Awesome. So the top question right now, and I think we have to address it, is the ERC dead or alive for Q4? And I mean, if you want, I can answer this, and maybe Melissa, Miriam, you can come behind me on this. I always defer to you guys anyway for all of the thought leadership here. But the answer to that, as your ERC specialists say, it's not decided yet. So it's in the other bill, and probably when we work through these pay-fors, to me, it's a very obvious pay-for that if they take it away, it creates funding for these other, for all of the other things that we're trying to do. However, it still isn't finally. Melissa, Miriam, do you have anything else to add to that?
There seems to be a lot of movement with the reconciliation bill. We don't see a lot of movement with the provisions in the infrastructure bill, right? But then the pushback is, well, we've already started Q4. How does that work from a fairness perspective, from an administrative perspective? And I always have to remind folks that's not what we really focus on in DC, right? It's very much what is the cost, and they're looking big picture. They're not looking at it like what CPAs think about things of how are you going to put this on a tax return or a payroll form if the quarter's already started, and how do you plan from a business perspective? Maybe you were counting on that cash. So there were a lot of challenges surrounding it, but I don't think, given everything that's going on in DC right now, that they're focused on the administrative and cash flow challenges surrounding this important credit for many of our clients.
Yeah, and I think the other thing going in that direction is the fact that bipartisan package already passed the Senate. And so I don't know that they're really going to want to mess with that at this point. And so I think, it's going to be difficult, despite the fact that we're getting later into the year, it's going to be difficult to rework that package.
That makes a lot of sense to me. And what I've been advising folks to do is, again, if you are reducing those withholding deposits, just do so in, keeping in mind that may not be available, and you likely have to pay it in as part of your 941, timely filed return. One nice thing about that is, I'm guessing, and just based on my observations of the last 2 years, is if what we expect to happen, which is it goes away in Q4, the IRS is going to have to come out with some kind of direction about what to do with it. And my hope is that when they do that, they'll speak to some of these other unknowns that we've dealt with and create some more certainty around claiming the credit and eligibility for the credit, which would be nice. We saw that in the Rev Proc, we saw it in really each of the notices where they come out to address one thing, but then they say, oh, and while we've got you, we're going to talk about something else. And so that might really help us when it comes to some of these unknowns about provider relief funds or what have you. So another question we have, and this will probably be our last one for today as we're coming up close on time, but we've got, it looks like, a few questions on this IRA conversion to a Roth, and any restrictions on the Roth conversions and how you approach that analysis. So Melissa, did you want to comment on that a little bit, and then we'll wrap up for the day?
I'm happy to give it my first best shot, and then Marion can correct anything that I say is wrong. There are currently two different main types of IRAs, the regular IRAs that we make contributions to, and then Roth IRA contributions. And there are income limits to being able to contribute to a Roth IRA, which is post-tax, but then, it grows tax-free. So what a lot of people do, they call it a backdoor Roth, where you make a contribution to the regular IRA because there are no limits, and then you make a conversion to a Roth IRA. I believe what they're doing in the proposal is they are having two buckets. Let's say the grandfathering rule, if contributions have already been made to a traditional IRA, if you're under an income limit, you would still be able to convert that to a Roth IRA going forward. If you're above a certain threshold, and I don't remember the exact number, I want to say it's 400, 450, or 500. It's all around that area. Then you would only have, I believe, 10 years to convert those existing funds and existing traditional IRAs to a Roth IRA. But going forward for future contributions starting next year, that opportunity would be completely shut down for everyone. There wouldn't be an income limit per se. They would just shut it down, and either you qualify to be able to contribute to a Roth IRA or you don't. Do you happen to remember those exact thresholds, Miriam? If it's
no, I don't.
400, 450, 500, that's what makes this entire thing confusing. Not only the back and forth, but different thresholds for different provisions. Yep. And different effective dates for different provisions. So just trying to keep track of all of the different details is a full-time job, Jen.
Yeah, absolutely. As you and I know very, very well. And it's nice that it's entertaining for us to like read this stuff at night and after kids go to bed, but it's also it is a full-time job, and then you seem to, put a pin in it, and then all of a sudden everything shifts again. So I think this is going to be a really even more impactful conversation once everything gets finalized and passed. But in the meantime, I think my key takeaway from both of you is let's just keep those dialogues going with your tax advisor so that you can have the flexible planning in place and really understand what could happen and be aware of it so that you've got your backup in case it does happen. Well, unfortunately, friends, that's all we have time for today. And this was such a great session with great information. Miriam, Melissa, thank you for your time today and just the effort and research you put into it, staying up with our current legislation that we saw yesterday and what we're seeing this week. Thank you to our audience for all of your engagement and questions. And thank you to our moderators and just the team that runs the show to keep everything moving for us today. Everybody did a great job. We're looking forward to seeing you as we progress with some of the other programming that I mentioned at the beginning and next week on the live stream. So until then, have a great weekend and stay safe and healthy.